Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, member KM190 gets into the details of what made him stand out from his peers in order to make it to investment banking and eventually private equity from a complete non-target. This is part two of a two-part series since we go into a lot of depth. In this segment, we cover his struggle to make the transition from investment banking to private equity, as well as his jump from his first PE fund to the one where he currently works. Find out how he eventually broke in and why he left his first private equity fund. Enjoy. So okay, you're at this bank. You're there for a few years. When does the whole private equity recruiting madness start? Do you do on cycle for, are you getting recruited 6 months under the job, 8 months under the job? What was that whole spiel like, or did you have to kind of fight for that as well?
I think everyone has to fight for private equity jobs. Mm-hmm. And look, I think there is a mass hysteria, and I'm looking forward to discussing this with you in detail. But yes. I think there's this hysteria around private equity, and a lot of people have major misconceptions about what this industry is and what the true potential actually is. Mm-hmm. So I joined the standard recruiting, cycle 6-8 months in. To be very open and upfront with you, because I feel like on Wall Street Oasis there's this misconception that you have to be polished, crystal clear, ready to go in 6 to 8 months, or else you're screwed. I wasn't that prepared, mm-hmm. and so I actually struck out on a lot of my interviews initially, mm-hmm. and and
you were ready for the paper LBO this time, though. I bet.
I was ready for the paper LBO, absolutely.
Okay, so go ahead.
I at least got that part right, but. But look, the truth is that it's really the biggest of the biggest funds that are doing and leading the on-cycle process 6 to 8 months in.
Right.
You then have hundreds and hundreds of really good funds that are pretty flexible. Mm-hmm. I got my offer, in my second year.
Yep.
And I was okay with that. In fact, a lot of my analyst class got their offers in their second year as well. And they were all very good funds in really desirable places. Yep. And so look, I think, with that, private equity is a little bit different. It's not the same bravado that you see with the bankers. You don't see this, you don't see like the asshole personalities. You just don't see that.
Yep.
Here you see much more down to earth people, but
mm-hmm.
they're much more cerebral, much more intelligent, in my opinion.
Okay.
And what that means is you really, really have to prime your approach accordingly. You could say, okay, your technicals, but you really, really have to know everything. Like you have to know the story, mm-hmm. and then almost like back into the technicals. It's not about like, okay, I know how to do an LBO. It's kind of like, okay, well, walk me through why we're even doing this in the first place.
Right.
And so, and look, some free advertising for you, the Wall Street Oasis PE guide. Every person who wants to get into this space, they need that guide. They need to understand, because otherwise, it's such a secretive industry. There's not that much information out there, and you don't want to risk taking in all this data and then, presenting yourself as an interviewee in a wrong way, or in a way that doesn't really mesh with the reality.
No, I appreciate that shout out. I think the other thing we're actually releasing soon that I think is going to be another thing is specific deal cheat sheets for people, with actually audio of people talking through their deals, because almost like a template.
Yes.
Because one of the most important parts, besides knowing if you get an LBO modeling test, yes, you need to do well on it, but the other really key part is being able to speak about your deals like an investor. And so actually sounding intelligent, being able to talk about the industry, being able to talk about the strengths, weaknesses, what were the risks of the deal, understanding all the financials behind it, yes, all that good stuff, but kind of having a template and,
right.
and being able to like listen to other people who actually broke into private equity talk about their deals. We're focusing on getting like that released in the next version in that package, so we're excited about that. But yeah, thank you for the shout out. So
that will be incredible, because
yeah, I'm excited.
Private equity interviews are like 40% talking through your deals.
Exactly. So we're just going to try to compile this like library of deals of like deal cheat sheets
Yeah.
and audio, so people
Yeah.
talking through it. But okay, so you're basically you strike out in this first kind of series. Do you think did you feel like you had a good chance? Was it the fact that your bank wasn't as strongly represented? Were you striking out like in the first round, second rounds? Can you give me a little more info on that?
Of course. Yep. Look, I think in the very beginning, I had 4 interviews.
Yep.
And 4 different funds.
Yep.
The first one struck out first round. The second one, it's funny how this works. Second one struck out in the third round.
Yep.
The third one and the fourth one I struck out on the Super Day. Oof. So, I quickly kind of adapted or tried to adapt. And what I noticed actually in private equity interviews is that they're all surprisingly consistent, which is really strange. Mm-hmm. Banking interviews have a lot more variability, but private equity interviews, they're going to ask you the same kind of things, and they're going to ask you to talk through certain things, and there is more of a right answer and more of a wrong answer, I feel like, mm-hmm. with this interview process than there is with banking.
Yep.
You also know a lot more, so you're expected to show that. And so, look, the truth is, for every one spot, there are 10 bankers that are eager to get in. And there have been interview processes that I've gone to that, in a Super Day where I thought I had really good odds, I was sitting in a conference room with 10 or 11 other people that were candidates at that Super Day. And then the guys are saying, hey, we're going to hire 2 people.
Right. So it's just incredibly difficult. Yeah, it's incredibly difficult, especially at the larger funds, the mega funds and stuff like that, and where they literally have their choice of whatever bankers they want. And specifically, they tend to tap certain groups more than others. So
completely.
And it's kind of like follows if you don't have the pedigree from all the way from like elementary school up through, it can be even harder.
Right.
You didn't exactly fit the mold, but okay. So you still ended up at a great fund, and tell me a little bit about that process. You continue to kind of put yourself out there. You knew private equity is kind of what you wanted to do. Was there a reason for that? Did you feel like, was it something, were you just following the crowd? Hopefully Wall Street Oasis didn't brainwash you. But was it something where you felt like PE is the end all be all, or tell me a little bit about that?
I had an interesting experience before I even knew much about investment banking. This was probably in my second year of college, so going way back.
Yep.
And my dad at the time was heading this very big division of a very big company, and he was responsible for divesting a certain asset within that business to a private equity fund. Mm. And what's interesting is, look, I have a certain ethnicity that is not that common in finance, I feel like. Mm-hmm. And the partner of the private equity fund involved in the other end of the transaction also shared that ethnicity. Mm. So there was kind of a natural, kind of camaraderie between my dad and this partner, and it turned into an actual friendship. And so, very frequently this guy would actually come over whenever he was in town and come to dinner with us, with our family. Mm-hmm. And we treated him like family, and so this guy, a long time ago, it's funny, I remember now, and it's hilarious thinking about it, but he was always like, Kareem, you should come to the dark side, you should come do finance. And I'm saying, no, I want to do pre-med. But, I had an exposure to private equity before.
Yep.
And I think that exposure was incredibly valuable because I kind of understood like how these guys think and how they approach. Because look, the truth is, like, even in like normal everyday situations, like a private equity guy just naturally, you could tell like they think a little bit differently. They're a little bit more cerebral. They're a little bit more analytical. Mm-hmm. They'll run math in their head, casually. That's something
for fun.
You're right. It's weird, but it happens. I do it now too. And so look, but I think that kind of exposure can be replicated. And I think it's replicated through coffee chats and just getting in front of these people to understand.
Yep.
Okay. And there's no shame in saying, hey, like, I don't, I'd like to learn more about what you do. I don't think there's any shame in that.
For sure. So you're basically starting this process, or you're continuing this process because you made it to two two super days or two final rounds at these PE funds, ended up not getting the offer because the odds are tough, even though you had
Right.
improved your skills of interviewing. So then what was after that? This was already in your. This was kind of like you're turning into you're starting your second year at this point, right?
Right.
At the bank, and
Right.
so you just continued talking to recruiters, or how were you getting in front of more shops, and how many other interviews did you do?
I think this is probably a good time for me to talk about like what I think private equity funds are actually looking for.
Sure.
So, there is a misconception that because it's so competitive, that funds are more likely to pick the higher pedigreed guy. And the truth is, at least from my experience, that's not the case.
Mm-hmm.
The truth is, it's very similar to banking, which is, if you have everyday stats, state school, average GPA, maybe okayish bank, the best way to show that you're the right person for that job is to align yourself with their way of thinking. Make sure you frame your resume in a way that is really, really congruent with how they would evaluate something. Just make sure your presentation is very, very synonymous with how they think.
But what do you mean by that? So like, what you mean specific? Like if they specialize in a certain industry, like highlighting any deals you did in that industry, or is it something else? Like you say, congruent with how they think. Is it more like framing your deals a certain way, or how?
Yes.
Okay.
It's the number one way to show it in private equity interviews is to just the way that you talk about your deals.
Mm-hmm.
And at the very end, being sure to say, also what I liked about this and what I didn't like about this. And what, I think this would be a good fit for this kind of fund, but maybe not this one. That kind of like knowledge, right?
Yeah.
And it's all about, the person who succeeds in these kinds of interviews is the one who shows that they have a body of knowledge that they can pull from
mm-hmm.
that makes them more or less similar to the guys that are interviewing you. That's what I think.
Yeah,
I don't
absolutely.
think, sure, there is a correlation between pedigree, but I truly, truly believe that pedigree takes a back seat to raw competence, and they can test for raw competence pretty easily.
Mm-hmm. Yeah, it makes sense if you're showing incredible knowledge about their specific fund, their type of investment style, their industry, and like you're showing a passion for that too, and you're somehow aligning your previous experience with that. It's hard to say no. It's hard to
right.
You're gonna probably be in the final round and be given a good shot. So okay.
Right.
So that's great. So you're still interviewing. How did you get this kind of final one you ended up taking?
So I ultimately ended up getting this, or the first private equity offer,
mm-hmm.
Through a connection at the bank that I had cultivated my relationship with. So this guy, he headed one of the major groups at the bank, and he had a lot of relationships with a lot of sponsors.
Okay.
And, it was funny because he kept walking by my cube, and he's, "Oh, what are you doing?" I'm like, "Oh, I'm trying to figure out, XYZ fund." And it was almost by accident because every time he'd come by, I was looking at something private equity related. And, I came back from one interview, and I remember I was so mad at this one interview because they were checking references and they were doing all these things, and I'm thinking in my mind, like, okay, this is it. But then they come back and say, actually, your references are great, but we're going to go with someone else.
Oh.
So I was like really mad, and I naturally went to him, and I was like, listen, look what happened to me. And I think that's like, it was like that one story basically, led him to do a bunch of things behind the scenes. And like, I went back to my desk, and like within 2 days, he was CCing me on introductions to people unsolicited.
Yeah, and that was enough to give him. You're
right.
like, "Can you believe this?" And he's like, he felt bad for you. Then he started pushing you to all his connections.
It was amazing.
That's great, man. That's incredible. Like That's incredible to get that support, because I know that
right.
At least at Rothschild, I think they were not happy with me leaving when I did.
Yeah, more of a career track type.
Yeah, it was more like they wanted you to stay and get promoted to associate and stay on, which is great. I mean, I think I could have done really well there, but it was just more like I wanted to get back to Boston. But okay, so this is awesome. So you cultivated that relationship enough where he felt like, I'm going to support this guy, and and he started CCing you on warm intros, so that it was like you were basically in final rounds almost immediately, I assume.
That's exactly right.
Yeah.
And look, you know, there's a level of gratitude that I have for being in my seat because, you know, when I got my first offer, the partner at the fund, you know, he was very upfront. He said, listen, I don't think we would be chatting, and it's not a reflection on you. It's just a reflection on circumstance, but I don't think we would be chatting had it not been for this contact.
Of course. Yeah.
That's what he told me within minutes.
Yeah.
And it went very positively from there. It was a great team. You know, similar work to what I was kind of doing in banking industry-wise. And it was a good fit. It was great.
That's great. And so you were there for a few years. You, I assume, got some good deal experience while you were there. And then you want to tell me a little bit about your thought process in terms of, so you're in a seat. Is it like a 2-year program where you feel like you're pressured to move on after 2 years, or was it something like potential partner track? And what was the thought process of, hey, maybe it's time to lateral to a new fund?
Yeah. So good question. This was more of a look. It was kind of gray area, which is a little bit frustrating. Where, you know, they say, listen, you know, historically we've been 2 or 3 and out, but there's always the chance. There's kind of like they're being cute about it, right?
Right.
And look, it's interesting how this industry works. Private equity is a very antiquated, almost like dinosaurish type industry. And the largest funds are catching on. The largest funds are retaining talent and they're promoting within. The lower middle market funds, at least from my experience, I found that they're still more likely to hold on to the whole 2 and out or 3 and out. And
why do you think
that
is
ridiculous, especially for.
Why do you think that is?
I don't know. It escapes logic. It really, to me, it escapes logic.
Well, maybe they don't. Maybe they just want to keep cheap labor, right? I mean, maybe they don't want to pay people who become principals and associates if the funds
they don't want to give up their economics.
Right.
Totally.
Well, I think that's it.
But on the flip side, on the flip side is like, you know, you have a unique firm. It's a small firm, and I'm not just talking about my other fund, but all funds who do this. And it's like, you're a small organization. You've invested a lot of your time, energy, and money into training this junior associate.
Yeah.
Why not cultivate him and groom him instead of ultimately realizing that you're going to have to go expand your team and hire from the outside, which is a greater risk hire. It just doesn't make any sense.
Yeah, at least make it a 3 or 4 year thing, if you can. That makes sense. I think I see it from both angles. I agree with you. I think it depends really on fund size and how fundraising is going for the next fund, right? A lot of it.
Right.
So if it's like a $500 million fund and their fundraising is going really well, so they got some good exits, and it's going to be an $800 million fund, it's much easier to say, hey, yes, stay on. And it's also about the carry pool, right? So do they feel like they're going to have to give you a carry after a couple of years, or are they going to, you know, you're going to eventually demand a bigger title, especially if they bring on some other associates, right? So, and in the next fund, are they going to want to give you some of that, or even have that conversation? So I don't know. It's interesting.
Yep.
It's interesting that you say, and I guess maybe for the larger mega funds, there's so much more money and there's so much assets under management that it's like,
oh my gosh,
that it's just like they just want that infrastructure there of that second level of you know, principals and whatnot.
Yeah, it's like the dynamic, right? I mean, it's like an exponential increase in your economics with minimal increase in headcount,
right,
you know, relatively speaking. So, but look, that was the thought process that ultimately prompted me to lateral. And look, at the end of the day, I think that when you have enough experience in this industry, when you've been exposed to enough things, you start to develop a level of hard confidence, and you start to put boundaries, and you start to, you know, realize like what you are okay with and what you're not, professionally, you know, in terms of your advancement, because I do hold the opinion and that, you know, people that are more senior than you are going to extract as much value as they possibly can from you for as long as possible. And you have to kind of fight that and get what you want as well. And so I was not comfortable with the whole, oh, you know, maybe if you do another year, maybe we'll think about it. I basically went out and and this is the beauty of being in the space, is like when you're in,
much
a
easier.
very difficult space to crack. And once you're in, there's no more pedigree. There's no more nothing. It's basically, okay, he has experience. He's deal reps. And I'm fortunate to have found a good spot here. But yeah.
Now, how did you do the deciding factor? So it was basically the vagueness around potential future for you that just said, okay, it's time to move. That totally get that. It makes 100% sense. But how are you in your current seat? How are you doing the diligence in that recruiting process that you wouldn't get, some kind of similar answer, or that answer wouldn't slightly change once you kind of accepted at this new place? What gave you that confidence? Was just enough conversations, or can you explain how that went down and how you did that research?
Private equity, I think someone released this stat, and they said that there are less people in private equity than there are professional athletes in the world. It's a very small family of people. And, when you're in, you have access to virtually anyone through a second or third degree. And so in diligencing the current firm, I reached out to a good friend of mine. He's actually, he's a recruiter, or was a recruiter at a very large, recruiting agency for private equity. And he basically put me in touch with some investors at this fund. And so I actually
Sorry, you broke up. Some of the what investors?
Some of the ex-investors of the fund.
Okay, got it.
Right. And so I got all the positives, the negatives. I got everything.
Great.
And so it was very easy to be confident in the decision.
Got it. And did you get more kind of, I guess, hard assurances around potential future? And
100%.
You did. Okay. And okay, so that makes the transition made sense then for you. It was kind of a no-brainer. You had less assurance at your previous place. You had a lot more kind of clear path at your. And is this like a partner track potential position then?
Definitely,
it is.
And
okay,
there's economics, upside, equity upside in writing. And look, after a while, like you need to start demanding these things, otherwise.
It just doesn't happen.
Finance is a ruthless industry. Like if you are comfortable, you will stay where you are.
Yeah.
And so
they're not going to give you stuff you don't ask for.
Right. Because ultimately the way it works in PE is like, in order for the partner to promote you, it means that he is lowering his own bonus.
Right.
That's just how it works.
Yep.
Lowering his overall comp.
Yep. So
that's just how the math is.
Do you mind sharing a little bit from when you went from banking up to your first fund and now to your second fund? Do you mind sharing compensation ranges? You don't have to give me exact what you were paid, but just to give us a ballpark of what you're paid as an investment banking analyst, and then at your first fund, and then now at this fund, maybe some rough carry numbers as well would be helpful.
Of course. So, look, investment banking, you're going to have, I think, traditionally as a first year, it's like 85 base plus whatever, 55 to 75 in bonus.
Yep.
And then it kind of tiers up after that. With private equity, look, it varies across the spectrum. Lower middle market, I'm talking either fundless sponsors up to like 200 million. You're probably talking about, sub 200 in all in comp.
Yep.
Middle market, 200 plus to like call it 600. You should expect to break 200 with economics.
Yep.
Oftentimes the cash portion should get you there, and then you have economic, upside with carry and co-invest.
You think even for pre-MBA associates, has that become more common? Do you think in recent years,
yes.
the giving carry to pre-MBA associates?
So.
Okay.
Yep.
And how should people think about that? I mean, how much value do you actually place on that? I mean, it's probably a small amount of carry, and you gotta wait many years.
You usually get it a year if you stay that long.
You get it when? Sorry, you broke up.
At the end of your second year.
Got it. Okay.
So look, the carry. I didn't receive carry at my first fund. Here at the current fund, I don't want to give away too much, but carry basically happens after being here for a reasonably short amount of time.
Okay.
And so I don't have too much visibility into what that looks like. But look, most funds should give you the option to, co-invest. And, if they're good, they'll give you the option to do a levered co-invest.
Levered co-invest?
Which is very attractive.
Yep.
Right.
And can you explain that a little bit to the listeners?
Of course. So levered co-invest, basically, we can use some numbers here, dummy numbers, for example. Let's say that I want to invest $50,000 into a deal that we're looking at.
Yep.
They give me the option, hypothetically, to do a 2-to-1 levered co-invest, meaning they will put in 2x the amount that I put in and count it as my going in principal. So if I put in 50, the fund will put in 100, and that will be a total going in principal of 150.
So the 150 will be all under your name. So the 150 will be your principal. It's almost like a bonus.
Right.
Oh wow, that's amazing.
Right. So you're going to have 150 going in, and let's say your deal does well, and you have 3 times. So a 3 times return in whatever 4 or 5 years. So you're now left with $450,000.
Yep.
That's your exit consideration, but you now have to repay the initial 100 in the fund's contribution.
Got it.
And so sometimes funds will either say, okay, there's no interest rate attached to it, or maybe there's nominal whatever prime rate or something.
Wow. So you're getting some cheap money to basically lever up your principal and participate in a larger way.
Right.
That's amazing.
So
what happens if it goes down? If it goes down, you just lose your capital.
Right.
Yeah. Got it.
That's exactly right.
Got it. Okay.
And you're not. It's basically a risk-free way to boost your returns because, look, all the numbers are the way they shake out is if you were to do 50 at 3 times unlevered, you'd have 150.
Right.
That's great.
Yeah.
If you did 50 2-to-1 levered co-invest, you would end up with $350K in net proceeds after paying back your debt, assuming no interest.
Yeah, which is not
so
bad.
You're going from, right.
You're getting over 6x. You're getting over 6x instead of 3x.
Right.
Yeah.
Right. It's a multiplier, and look, it's very significant because you're basically working at a place that is also investing your money for you. No need for the stock market or anything. It's a better return. It's more visibility because you have all the information.
Right.
And so it's a great perk.
Yeah, for sure. That's awesome. That would, it's kind of a no-brainer. As long as you feel like they're making good investments, right? Because it could, being somewhat concentrated in the sense of, let's say you're putting all your additional capital that you're earning into the co-invest, and then the fund actually goes south. You could lose your job and your co-invest. So. Yeah.
Exactly.
You got to diversify a little bit. But anyways, anything else before wrapping up? Any other kind of words of wisdom you would give your younger self or to these listeners that are kind of interested in kind of following your footsteps?
Yeah, a few things. So the first thing, when you look at my story and you look at other stories, I don't think my story is that unique. I think what has consistently differentiated me, and I feel it's differentiated me, is the way that I present and the way that, I try to find some congruence between myself and the person interviewing me or the firm interviewing me. I try to make it as an easy sell as possible for them. And, I try to align myself and try to basically be an insider or give off the impression that I'm an insider as much as possible so that it maximizes my chances. I think that approach has worked.
Yep.
The act of selling yourself effectively, I argue, is much more important than prestige. I don't think there's really, if the standard idea of prestige beats everything is true, then I don't think a guy like myself would be in this position.
Correct.
Just respectfully saying, I think too, people really have to, I can't say this enough. People really need to isolate the noise and the hysteria of wanting to get into investment banking and private equity and really understand if it makes sense for them. You can't be doing something just because everyone else is doing it. The truth is, private equity was an incredible vehicle back in the 80s and early 90s when not that many people were doing it. But now you have hordes and hordes of people going into it thinking, oh, I'm going to make my riches too. Right. But the truth is, in finance historically, if you read all the major books, the people that have made outsized wealth, significant wealth, are the ones that have been contrarians. They're not the ones following the pack.
So you're saying stay in banking. You're saying stay in banking and get quickly promoted up through the ranks. No, I'm joking.
No, I mean,
I'm kidding. Go ahead.
There's
some truth to that. I've been saying it. The pendulum has swung so far for PE. I mean, there's an argument to be made. If you're super sharp and you're good at sales, stay in banking and make it rain. Right. But anyways, so go ahead.
And the truth is, I'm seeing so many people that are so hyper eager and so it's almost like they're desperate to break in,
right?
And they're going to do anything they can to break in. Goldman, I think some question came up in one of their interviews. It's like, hey, like, would you let me sleep with your girlfriend if we gave you a job? And some people were like laughing about that on Wall Street Oasis, but like, I mean, it's a joke, but the truth is like there's some element of reality to that, right?
Yeah.
People are so desperate to get these jobs, and the beauty of private equity, and I'm really thankful for this, is that you get a lot of exposure. And I see a lot of founders. I see a lot of people that have made significant amounts of money doing things that are just completely unconventional. I mean, look, I'll give you an example. I have, someone that I know in my network who started an e-commerce store that sells bracelets and cheap earrings. And he somehow found a cult following on social media. The guy's a very good social media guy, and he got this thing to go viral. He kept it for a number of years, and he recently sold it for a $100 million plus valuation to one of the big department stores.
Unbelievable.
And this guy has no finance background, has no whatever.
Yep.
And then there are countless management presentations that we've attended, and it's funny because we're over here, the private equity guys, we're the ones giving these founders liquidity, and I can tell you stories and stories and stories of people making 100 plus, 200 plus million, all this crazy stuff, doing the weirdest things.
Yeah.
And so people, you have to realize, like, as you grow older, there's an opportunity cost, and it keeps going up exponentially. And you have to know what you're doing 5 steps ahead, or else you're stuck.
Yeah.
And if the goal is money, there are a million ways to make money.
Yeah.
Private equity is the safe way. Investment banking is the safe way. You will work extremely hard.
You have to
This
earn
is
that.
not an industry that is like 9 to 5. It's not 9 to 6. It's really like a 9 to 9.
Yep. Yep.
And so you have to keep that in mind. Are you willing to do that until you're 45 or 50? Because that's what it takes in order to make anywhere near the amount of wealth that you're probably envisioning as, a very naive undergrad thinking, oh, I'm going to go in and make millions. Like,
right.
You're going to work for that, and you may not even get there.
Yeah, you may get a great gray beard like myself doing it too. So.
We're all getting there.
Yeah. You a little bit later than me, but yeah, you'll be there one day soon.
Yeah.
Cool,
right.
man. Well, listen, thank you so much for taking the time. This is officially the longest podcast, but I think one of the most insightful. So thank you for taking the time to really share your knowledge. And yeah, let's stay in touch, man.
Absolutely.
Right. And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, patrick@wallstreetoasis.com. And until next time.